my junior star final project. My name is Sam Saperstein. Now, part of my presentation is going to be almost identical to my biology presentation. So if you're in biology, you may have already heard some of this. So this is my sort of visual representation that was required, and all that different stuff. And I'm going to expand all this soon, so you don't really need this down. So this is something that I had on my biology one. This is an example of that. So how did I spend the last 5 months? I chose a topic, which is the information about what the stock market is, how it works. Now I researched, I shared, I did more research, I did more sharing, I compiled all the information and finally presented it, which is this stage. So what did I look at? What are some of the things I looked at? Now, of course, this is more of a table of contents rather than the actual information, which I will get into, don't worry. So, what I looked at the basic definition of the stock market. Right? If someone said you have 5 seconds to tell me one sentence about the stock market, that's what I got. And that was the biggest goal of my presentation, to sort of get those terms down. But then also go a little more depth into terms. I have a huge list of terms. I'm just going to skip through those, just a fair warning, because I didn't realize how long a time I would be. So I also looked at 52-week high and low. I looked at PE ratio and also some different documents to look at, such as balance sheets, income statements, and other sorts of different forms which I will get into. Cash flow statements and tax documents. Oh, I guess I did that. So, what is the basic definition? Now I'm looking at the board because I'm just going to read what I found. I said it's a broad term to describe transactions of shares of a company's stock. So now these stocks are listed on what is an exchange. So the different exchanges, which do things such as track the supply and demand, which relates to stock price. So the stock exchange is really where all this is happening. Here's some terms. So a portfolio, I'm going to say this in more simple words, not necessarily a perfect definition, but a portfolio is sort of like where your money is. So if you go onto like Robinhood, for example, I know some people here use Robinhood, that main page shows up with all of your stocks or your portfolios. Or if you go into Yahoo Finance, you can say my portfolios, and that'll show all your different portfolios to list of stocks. Now, bulls and bears are referred to, or what determines whether a stock is a good or a bad stock. So a bull stock is stock that you want to buy. It's doing very well. A bear stock is not doing very well. So when someone says as a term, you probably haven't heard this, but some people say like bull market when people go out and like spend a lot of money or something like that. There's also blue chip stocks, which are huge stocks like Apple. A broker is someone, in the past there was a physical person who would have to do the trade. Now it's things like Robinhood, Fidelity, Acorn, all of that. Day trading is when you trade and buy and sell the stock. The broad term is when you buy and sell a stock on the same day. So if I say, okay, I want to get Apple just because I think it's going to go up a little bit today, I'll buy it and then I'll sell it on the same day and take that. Day trading is not good. Again, it's not good for day trading. And then a dividend, I'm going to get into, I think, and then buying a margin is also something, and then shorting a stock, which is when you short a stock, that means you bet against it. So most of the time you'll buy a stock and say, okay, when the share price goes up, then you'll make money. But if you think it's a bad stock, like a company that's failing, you don't want to short it or put it. So what are the types of orders? The first one I'm going to go over is market orders. Market orders are the quickest and easiest. They're the quickest order. And they happen immediately unless the market's closed. So there's very simple orders. There are not many conditions. So what we call different orders conditional orders sometimes. So we'll get to right now. So limit orders are a type of conditional order. Now there's a buy and sell limit order. So a buy in the stock when it reaches a certain price is a buy limit order, and selling it when it reaches a certain price is a sell limit order. Now this is instead of you having to do it. So let's say you have a job or something and you think, okay, here is this stock that I think is going to go up to this price. That's what I want to buy. Instead of you having to be like, okay, I want to look here. I want to look here, and I want to see, okay, this is what I want to buy. The stock market will do. And also, so when you're buying a stock, you may say, okay, I want to buy one share of this company, and the stock is $100. But that's the I'm forgetting to really. So that's not necessarily the price that you're going to pay for it. So that's another use of conditional orders. Because you don't necessarily know. If you just put out a flat order, a market order, you don't know exactly how much that stock is going to sell for. So now stop orders are buying or selling stock at the market price. It's good for attempt to protect your gain should it begin to fall. And good for risk assessment. In terms of the first like sort of point there, it's good to protect your gain should it begin to fall. So you made a ton of money. Let's say you bought a stock super low and it's gone up. And you think it's going to still go up, but you don't want to sell the stock. Just make a stop order, or some people say stop loss order. And that means that if the stock goes down to a certain point, you'll sell it. You don't want to sell it too low, because with normal stock fluctuation, you'll buy and sell. And then risky stocks, if you have like a pharmaceutical company, like I'm not sure if some of you have heard me and Becker talk about IBRX. That's a pharmaceutical company that I use, or that I have in my game with him, and that stock can easily crash because if they have bad news, when it comes up, the stock will crash, and that's something that you use a stop order for. Now, if these be high and low, help predict stock movement. The high is the highest price in a period of time, generally 52 weeks. We're talking about 52 weeks. That's about a year, more or less. And the low is the lowest that it is in those 52-week periods. P/E ratio is the points to earnings ratio, or price to earnings ratio. Sorry, I'm so used to talking about points. But company share price to the company's earnings per share. So it's that ratio. And then, as you can see, it's the share price over the earnings per share. And then shows what the market's willing to pay for its stocks. And you'll see a little bit more what that means. So the low ratio, this means that the stock is underpriced and has potential to grow. So it's indication of a struggle possibly, but you also get quicker returns. High P/E ratio is a high demand and possibly the stock is overvalued. Now, a lower P/E ratio is oftentimes you want to look for a lower P/E ratio. Something like Tesla is, in my opinion, not a smart investment because it has a very high P/E ratio in the thousands, when most stocks are under 50 in terms of their P/E ratio, which means that it's possibly overvalued and it could crash. There's a lot of volatility and it could crash in that stock. And it's a low ratio. It's better, but if you're looking at some companies that are sort of in the same category, you want to be somewhere towards the middle range. So now there's a few documents. Now there's tons of documents that a company has to file that can help you in investing. But there's a few that I mentioned. There's a balance sheet, and the balance sheet shows the liability, shareholders' equity, and assets of the company at a certain time that provides foundation for calculating return rates. And then an income statement shows a financial performance of a company over a certain time period. I'm trying to rush through because I want to spend 10 minutes. Now there's also the cash flow statement, which shows the data for all cash inflows that the company receives, and then tax documents. I'm not going to really say these. It's the tax documents. There's so many of them you could look at. Now, some are good. Pretty much in research, like I mentioned, I was able to research all about the stocks. In my presentation, presentation skills, whether it's Genius Hour or this. And I also worked on public speaking. And it's like right now I'm not public speaking. I also learned how the stock market works. That's the biggest one. Definition and just information about the stock market. I learned the terms, the types of orders, things you can low P/E ratio, and types of documents. I'm no longer a zoo tiger, and